Okay, thanks for placing this paper in the program. It kind of complements I think, in a nice way the previous one, because it is about the extent to which climate risk is actually priced in the credit market rather than in securities markets. It's joint work with Carlo Altavilla and Miguel Boucinha from the ECB, so that the standard disclaimer applies, and, and Andrea Polo from Lewis University. So we really address or try to address two related questions. The first is whether banks price or do not price climate risk, especially in the euro area, when granting loans. And the second is, insofar as they do, does monetary policy affect the price that they place on climate risk? Now, the first question may seem to some extent strange, because banks should actually price default risk, and therefore, insofar as climate risk induces a certain amount of default risk, should already be taken into account in their pricing of default risk. However, banks' internal risk models may not fully account for climate risk. We will say more about this. And on top of that, banks may internalize social attitudes regarding climate risk over and above its effect on the solvency risk of their clients. Moreover, we look, when we ask whether banks price climate risk or not, we take into account both the extent to which climate risk is captured by the current emissions of their clients, and the extent to which actually their clients are planning to reduce those emissions in the future. So in a way, we also look at a kind of forward-looking measure of climate risk. And we also take into account, or try to take into account, whether there is an heterogeneity among banks in pricing climate risk, in the sense that banks committed to decarbonization may actually be placing a larger price on climate risk in lending compared to banks that do not take this commitment. Now, these questions, to some extent, as you will see, have already been addressed in the literature. The second question, which is whether monetary policy affects banks' pricing on climate risk, and if so, how, this question has not, to our knowledge at least so far, being considered in the literature. And in principle, we could have two completely opposite predictions, depending on the model we consider, regarding the way monetary policy transmits to the pricing of credit risk, or the pricing of risk by banks. One is the well-known risk-taking channel of monetary policy, by which monetary tightening tends to discourage banks to take risk, and insofar as this is not just taking default risk, but also taking climate risk, it should prompt banks to become relatively more strict in lending to firms that are brown, the firms that are more exposed to climate risk. Conversely, according to the financial friction channel, what should happen is that if monetary policy becomes more restrictive, it affects relatively more fragile firms, or firms that face greater credit constraints, insofar as we believe, and there are reasons I will tell you why we may think that low emission firms, green firms, tend to face more severe financial constraints. This would predict that a monetary tightening should actually discourage relatively more lending to such firms, to green firms, rather than to brown firms. So it's completely the opposite prediction. Monetary restriction should prompt banks to raise lending rates relatively more to firms that are less exposed, green firms, less exposed to climate risk. Okay, so what do we find? We answer yes to both of these questions. The first one we find indeed that banks price climate risk over and above solvency risk, over and above credit risk when they grant loans. In particular, they not only charge higher interest rates to brown firms relative to green ones, defining brown and green with reference to transition risk, but controlling for their probability of default. But they also charge relatively lower rates to brown firms that are planning or declare that they are planning to reduce their emissions in the future. So that in kind of prospective terms are planning to make the transition towards becoming greener. And both of these effects we find are larger for banks that are committed to decarbonization. Regarding the impact of monetary policy, we find that consistently with the climate risk-taking channel of monetary policy, what happens is that when the central bank tightens, and here we're talking about the ECB since our data refers to the euro area, when the ECB unexpectedly tightens its monetary policy, it induces banks to increase both credit risk premia and climate risk premium, so become relatively, more stringent, both with the riskier borrowers, in the sense of those that have higher probability of default, and those that have higher carbon emissions. So, in this sense, restrictive monetary policy is more penalizing, relatively more penalizing for more polluting firms. This should not be taken to mean that restrictive monetary policy is environmentally friendly. Because to some extent, of course, a monetary restriction tends to reduce investment across the board, including investment to make a transition towards a greener production. And therefore, it has a baseline negative, one can expect it has a negative effect on lending altogether. What we are saying is that its contractionary effect is relatively milder for firms with low emissions than those with high emissions, and for firms that commit to decarbonization, those then don't. So essentially, it is a relative statement. It is not an absolute statement. It's not saying that jacking up policy rates is actually to save the environment. Okay, in terms of the literature, well, the previous paper did a great job on the security markets front. It gave us like a big fresco, essentially, of the literature, and also it made an important step forward in that literature, telling us that overall, if you take all those measures into account and the different methodologies into account, you can say that there is a greenium. And it was actually my impression that the literature on average was already kind of suggesting such an overall conclusion, but the paper actually shows very persuasively that the effect, if you assess all the papers in the previous literature altogether, is actually zero, but eventually they come down on the side of finding a greenium, however small, in securities markets. If anything, in credit markets, the literature is even less clear. First, because it is limited only to syndicated loan market, which is just a segment of the loan market. And there we have a paper that finds no greenium in a way. It finds that the paper by Bayen and co-authors finds that banks do not charge relatively higher interest rates to fossil fuel producers who have stranded assets or potentially stranded assets, whereas another paper by Ehlers and de Graaf finds that in the syndicated loan market there is indeed a greenium after 2015, so after the Paris Agreement. There is even less agreement, if possible, regarding whether bank commitment to environmental policies leads them to price climate risk relatively more. There are papers that say no, like again Ehlers and de Graaf, and there is a recent paper by Giannetti and co-authors that actually finds that banks that declare to be relatively more concerned with credit risk actually with climate risk actually lend more to brown firms. Using text analysis to detect whether banks have a concern for the environment or not. And then there are two papers, one by de Graaf and co-authors and one by Kaspersky and Pedro, that find actually the opposite, find that banks more committed to environmental policies do lend preferentially to low emission firms and do actually give them relatively lower rates. And of course, here some of the differences are stem from different definitions of what commitment means, different data, and so forth, and so on. And instead, there is no evidence in the literature on the impact of monetary policy on the pricing of climate risk. And here, as I mentioned before, very briefly, you can have two different views, depending on whether you are on the side of the risk-taking channel of monetary policy or rather of the financial constraints channel of monetary policy. As you know, the risk-taking channel of monetary policy is based on the idea that monetary policy affects banks' yield-seeking incentives, so that a monetary expansion induces banks to engage relatively more in yield seeking and so to take more credit risk, whereas the monetary tightening does the opposite. And this is based on models of moral hazard, so incentive problems essentially within banks. There is a paper by Achade and Nakvi, and there is another one by De La Riccia and co-authors that propose different models of incentive issues within firms that result in a similar prediction, that is that abundant liquidity, low interest, low policy rates tend to induce banks to relax their internal monitoring of loan officers and take relatively more risk on board. And at this point, they would be taking not only maybe more credit risk, but also more climate risk. There is evidence already regarding the fact that they take more credit risk. De La Riccia, Leven, and Suarez, for instance, find that US banks lower their internal risk rating of new loans when short-term interest rates rise, so becomes relatively stricter in lending to risky borrowers. There is a paper by Jimenez and co-authors, the Econometrica paper, using the data from the Central de Riesgos in Spain, showing that as overnight rates drop, less capitalized Spanish banks relax lending standards to risky firms. And there is a more recent paper by Anderson and Cesabianchi that show that monetary tightening triggers a larger rise in credit spreads for high leverage firms, so relatively riskier firms, mainly due to a higher risk premium. So if we extend, in a way, these models to not only to credit risk-taking by banks, but also to climate risk-taking, then the prediction would be that monetary policy tightening should be, as I said, relatively more restrictive for brown firms than green ones. If instead you take the view that, say by Bernanke and Gertler, that monetary policy shocks have stronger effects on lending to firms facing tighter financial constraints, that is those for which firms, banks have less information or can offer less collateral, then you would conclude the opposite of what I just said, that is that a monetary policy restriction would be relatively more harmful for green firms to the extent that you think that green firms indeed face tighter financial constraints. Do we have reasons to think that? Well, green firms rely on more innovative technologies typically than brown firms. These technologies are relatively unfamiliar to banks. And to the extent that banks feature technological conservatism, as argued, for instance, by Minetti in his 2011 paper, you would expect them to be relatively more credit constrained. In fact, that's his conclusion also empirically. Green firms have a lower fraction typically of tangible assets, as shown by Jovino, Martin, and Sauvagnat. And to the extent that these assets are easier to collateralize, to be offered as collateral, then you would expect also on this account firms with low carbon emissions to be more credit constrained. And so if you combine these facts, therefore, with the role of financial frictions in monetary policy, you would expect then that a monetary restriction would be relatively more damaging, so to speak, to green firms than brown firms. So this is the opposite prediction relative to the previous one. Now, how do we, which data do we apply these predictions and our methodology? We use the credit register data for the entire euro area that is provided by Anacredit, the Anacredit database at the ECB, which covers all euro area countries and provides data both about interest rates and of course, loans and probabilities of default in the euro area for all the banks and firms in the euro area. We unfortunately have to focus only on listed firms because only for listed firms we have comparable data regarding emissions. We use the Refinitiv database to measure CO2 and CO2 equivalent Scope 1 and Scope 2 emission data. We look at emission rates, so as the previous paper, in one of many measures of the previous paper, we use the ratio between the 1,000 tons of emissions per million US dollars of net revenues of these firms. We also have, as I mentioned, a forward-looking measure of climate risk of emissions because we have some information regarding whether the firm commits to reduce emissions in the future, whether it has an emission target or not. And we use this measure only as a 0-1 dummy, indicating if the firm has disclosed or not an emission reduction target. And this is because the way these data are provided, they refer to different horizons and so on. So it is not easy to compare the quantitative amount of the reduction target across firms. So we prefer this kind of rough measure, a 0-1 measure of firm commitment to reduce future emissions. We know from other papers that firm commitment is associated with carbon emission reduction, so it's not cheap talk according to previous work. We complement this data with information about banks' environmental commitment by identifying committed banks with those that sign a commitment letter in the context of the Science-Based Targets Initiative, which is the same measure of commitment which has been used by Kaspersky and Pedro in their 2021 paper. We, of course, also need a measure for monetary policy surprises, and we use the high-frequency monetary policy surprises from the euro area monetary policy event study database, which has been developed by my co-author Carlo Altavilla in the previous work, has already been extensively used. It's similar to measures of monetary policy surprises which have been used in the United States. Now, in terms of descriptive statistics, our main dependent variable, as you will see, is the so-called spread. So it's the difference between the interest rate that banks charge to a given firm and the safe rate for the corresponding maturity. We also have data for the PD, which is the probability of default that the firms, the banks lending to that firm, assess for a given firm. That's our measure of credit risk. We measure, as I said, climate risk, both with carbon emissions and with this forward measure, this 0,1 measure of future emission, which is this target variable. We have data regarding, as I mentioned, the commitment of banks and the monetary policy shock. When positive, it means it's a restriction, unexpected restriction. When negative, it's an expansion. As you can see from this table, both the PD, our measure of credit risk, and the carbon emissions are very right-skewed. Essentially, it is only for the top decile that they exceed the mean value. You can also see that the majority of firms actually seems to have a target in terms of emissions, almost 60% does, but a minority of banks instead declare to be committed, at least using this SBTI commitment variable. Only 11% of our banks appear to commit to decarbonization. The monetary policy shock is on average positive during the period, because our data go from 2018 to 2023, which is a period in which most of the shocks have actually been restrictive. Let me move then to the results. First, in terms of, to illustrate what the data seem to say, just by looking at them, on the face of them, if you plot the premium that is charged by banks to firms with high carbon emissions, those in the top quartile by emissions, and those that they charge to firms with low carbon emissions, those in the bottom quartile, you see that the average rate the average premium is consistently higher for firms, for brown firms relative to green ones. The difference is not huge. We're talking on average 14 basis points. The difference looks as if it is actually becoming smaller, narrower towards the end, but that's actually just a graphic impression, because if you look at the difference, it's actually pretty stable over time. It is not very large, but it is stable. If you look at the right-hand side graph, you see the premia which are charged to firms without emission reduction targets, the red line, and those with emission reduction targets. Again, here banks seem to be relatively more, stricter in the rates that they charge to firms that are browner, in the sense here of not having an emission reduction target. The difference is 20 basis points on average. So on the face of it, just by looking at this data, it looks as if banks, euro area banks, are quote-unquote pricing climate risk. But of course, there is a lot of heterogeneity in the data by firm, sector, banks, and so on. So you better look at what panel regressions have to say. And the most basic specification that we have is one in which the dependent variable is this premium, loan premium charged by banks, and the explanatory variables are the PD, the credit risk, carbon, climate risk, target, whether firms are planning to reduce their emissions. And we find that, consistent with what one might expect, that riskier firms pay relatively more. Actually, not so much more. If you look at firms with the highest PD in the 90th percentile in column 1, they pay only 3 basis point premium, 4% of the standard deviation of the premium. Interestingly, they also firms that with the high emissions, those in the 90th percentile, the 10% brownest firms pay a premium, a 4 basis point premium, 5% of the standard deviation of the loan premium. The largest effect actually is that concerning firms that announce this commitment to a target reduction. They get a 10% basis point discount. Okay, so here we are comparing those for which this variable is 1, the target variable is 1 with 0. Okay, we also find that when we interact in column 3 and in column 5, we interact carbon with target, we find that the discount that firms get for committing to reduce emission is actually larger the browner is the firm. So essentially the more the greater its emission. So banks are seem to encourage, in particular, brown firms that announce this target with a reduction in interest rates with greater lending, with actually lower interest rates. Okay. Now, one obvious question which has come up over and over again with discussants and referees is why on earth do we get a climate risk premium if we are already controlling for credit risk premium? Why, in fact, the PD does not absorb the effect of climate risk as well? Now, at a theoretical level, this could be because climate risk tends to materialize on a different longer horizon relative than standard credit risk, which typically has a one-year horizon. If you look at how it is measured typically in internal risk models. Moreover, banks do not have an incentive, unless they are clearly told by a regulator, to incorporate climate risk in their PD, because this would mean that they have to put up more regulatory capital for brown firms than for green ones. But there is a also
question.
Yeah.
This is just, it's PD is the probability of default, right?
Yes.
So there's no measure at this point of how much you're going to get back if the company defaults.
Yeah, loss given default. Yeah.
Yes, that could explain some of that, right? Because it may be that it's an incomplete measure of losses, expected losses.
Yes, yes. An alternative measure would be to actually multiply the PD by loss given default for the
so
for these firms.
You have claims for that? What banks claim that is what is the number?
Yeah, yeah. I mean, in internal credit risk models, this is available as well. Now, a third reason why banks may be reluctant to actually formally take into account climate risk in their internal risk models is measurement issues. We saw in the previous paper by Mark how difficult it is to measure climate risk. How many measures already exist of climate risk, and therefore this actually applies to banks as well. Banks may simply not know which of the many measures to use, and as a matter of fact, we find empirically there is zero correlation between PD and emissions in our data, and that if you look at the ECB perception of things, for instance, you read the ECB Climate Risk Guide in 2020, it says even though we know that most banks in one way or another are trying to implement some sustainability policies in lending, only a small number of institutions have fully incorporated climate-related and environmental risk in their risk management framework. Okay, so that this may explain why we find climate risk over and above the PD as mattering in our regulations. We also have an expanded specification where on top of those three variables, carbon, target, and commitment, PD, carbon, and target that you saw before, we also control for commitment, whether banks are committed or not, and we interact the commitment with those measures of credit risk and climate risk. And what do we find? We find that more committed banks tend to actually be relatively more stricter with brown firms. So you see that the interaction with carbon comes out with a positive and significant coefficient. They tend to be relatively more lenient for firms that announce a target, and also give relatively less weight to default risk. So they seem to focus relatively more on climate risk relative to credit risk. Let me come to the last part of the paper where we look at monetary policy. And we first have one specification in which we not include time effects, because we want to make sure that the monetary policy shock meets the basic test of being correlated with with interest rates charged by banks. And we do in specification 1 find that indeed a monetary policy shock, restrictive monetary policy, is associated with higher lending rates by banks. And interestingly, if you look at, I don't know if I can, okay, sorry. If you look at the interaction between monetary policy and the PD, we find that it has a positive coefficient. This already is telling you that you know the risk channel of monetary policy, the credit risk channel of monetary policy seems to be there, because essentially a monetary restriction seems to be associated with relatively higher interest rates for riskier lenders. When we introduce time effects in all the other regression, of course, we can no longer estimate the direct impact effect of the monetary policy shock on lending rates, but we can still identify the interaction of monetary policy with the PD, with carbon, and with target. And what we find is, as I was saying at the beginning, that a monetary policy, restrictive monetary policy shock seems to be associated with relatively higher interest rates for riskier, not only for riskier borrowers in terms of credit risk, but also for firms which have higher climate risk, and has the opposite effect on firms that declare to have a target in terms of emissions. So the effects are relatively small. There is a 1.4 additional rise in premia for high emitters, and there is a 5 basis point smaller rise in premia for firms that are committed to an emission target. Okay, now, of course, we all know since Friedman's work that monetary policy acts with long and variable lags. And therefore, we may want to look at not only the impact effect of monetary policy on lending rates. By the way, we also have results on the impact effect of monetary policy on lending, the zero effect there, if you look at the impact effect. However, over time, we can imagine that credit supply may respond, because banks may take time to adjust their lending policy to a new monetary policy, and also firms may take time to adjust their investment, hiring, production decisions, so their demand for loans to a new policy by banks. So to capture that, we use local projection estimates to capture these dynamic effects, in which we look at the effect of the monetary policy shock on two outcome variables, the premia and loan amounts, and we interact them with the carbon emissions and the target of firms. And what we find, if we look at loan premia, we find a small effect on impact, and then over time, the impact of the monetary, this is baseline impact of the monetary policy shock on loan premia actually builds over time. So a 25 basis points surprise leads to a 39 basis points increase in lending spreads after 1 year. We find also, in agreement with our panel estimates, that the impact of the monetary policy is relatively larger for high carbon emitters. So we find that the 25 basis point surprise generates an additional 2 basis points rise in risk premia for high emitters, and there is a mitigation effect that actually builds up over time for committed firms and becomes 9 basis points after 12 months. What is more impressive is the impact on quantities. Again, the impact effect is zero, consistently with our panel regressions. But over time, as you would expect, a restrictive monetary policy shock leads to a sizable reduction in lending. So it's a 2.5% drop in lending. And there is an additional 2.7% drop in lending for high emitters after 12 months. Conversely, there is a mitigation effect, 1.5 mitigation effect for committed firms after 12 months. So the results also of these regressions are consistent with those from our panel regressions. Let me conclude only with one graph, actually two graphs, from, these are not from our estimates, these are from the bank lending survey, which is run every year by the ECB. And in July 2023, we were lucky enough that the ECB, so this is at the end of our estimation period, and it's also more or less at the end of the interval of time in which monetary policy has been mostly restrictive in the euro area. And what the ECB asked to firms, to banks, was whether in the previous year they had changed their lending policy differently for brown firms, green firms, and firms in transition. This is not normally asked by the ECB, but it was asked in this time. And what we see is that the banks that were answering this question, they replied that actually they restricted relatively more their lending to brown firms, both in terms of interest rates and in terms of availability of credit, compared to green firms and also to firms in transition, which happen to be in the middle. Moreover, it also asked whether, this was a separate question, this restriction was different depending on whether the bank, the firm had announced a target in terms of future emissions. And what you can see from those first two bars and from these is that the restriction has been relatively less for firms that are committed. So essentially, both in terms of interest rates and in terms of loan volumes, actually there has been relatively more lenient policy, even though this was at the time of credit restrictions on average, towards firms that had announced such a target. So just to conclude, essentially we can summarize the results by saying that indeed in the euro area, it looks as if banks are pricing climate risk to some extent. Again, looking at the previous paper, it doesn't look like these are huge numbers, so probably not quote-unquote enough in order to match what a carbon tax should really be doing. But so the magnitudes are not very large, but they do charge higher interest rates to firms with larger emissions, and they charge lower interest rates to firms that commit to green transition. Commitment by banks seems to matter. And monetary policy, when it is contractionary, leads to relatively higher premia and lower volumes to high emission firms. And conversely, it tends to mitigate the effects for firms that are committed to decarbonization. So let me stop here.
Okay, yeah, thanks a lot for the invitation to discuss this super nice paper. So yeah, my name is Doettling. I'm at Erasmus University in Rotterdam. So this paper, you know, kind of big picture is relating to how monetary policy affects the green transition. And the ECB has actually been taking a pretty, you know, proactive stance here, and, you know, in contrast to the Fed, wants to promote sustainable finance. And this paper is kind of taking a step back and asking, you know, what is actually the effect of regular non-target monetary policy that's not targeted to green and brown firms specifically? Regular monetary policy, does it already have a different effect on green and brown firms? So, yeah, more specifically, the two research questions are, do banks price climate transition risk in credit spreads? And second, how does monetary policy impact credit spreads of green and brown firms? And one thing that's super nice about this paper is, you know, you have this amazing credit register data, ANA credit, so you really observe all loans by Eurozone banks between September 2018 and December 2022. This is combined then with carbon emissions data, probability of default, some other financials. One thing to note here is, you know, because it's combined with carbon emissions data, and this data is only available for public firms, that means we only, this is really restricted to the sample of public firms. So I want to start by going over the key results again and thinking a bit about the magnitude of the results. And that's going to be my first comment in as well while summarizing this. Okay, so this is here the first key regression, regress credit spreads on probability of default, carbon emissions, and firms' emissions target. So what do we have? If you multiply this with the standard deviation of probability of default, you see one standard deviation higher probability of default means around 6 to 8 basis points higher credit spread. If we compare that to the carbon emissions, it's around 1 to 3 basis points higher credit spreads when you increase by 1 standard deviation. And then you have this relatively large effect compared to those other two from firms having an emissions reduction target. Yeah? So we see between 7 to 10 basis points reduction in credit spread if a firm announces a target. Then there's also this interactive effect. Yeah? So the effect of carbon emission on credit spreads is different for firms that do announce and do not announce the target. So if you take here column 3 estimates, if you don't have a target, then one standard deviation higher emissions means 2 basis points higher credit spread. And if you don't have a target, then 0.5 basis points. Okay, so that's the first set of results. Second set of results looks now at monetary policy. So monetary policy, basically, as you would expect, the baseline effect in column 1 shows us monetary policy tightening leads to an increase in credit spreads. And then column 2 shows us if we interact that with carbon emissions, we see this additional amplification effect. If you're a brown firm, then credit spreads increase particularly more. For example, if you think about a 10 basis points monetary surprise, then think of a firm that has 1 standard deviation higher emissions, that means a 0.5 basis points stronger increase in credit spreads, which is roughly 3.5% of the average effect in column 1. And again, we see a bigger effect of announcing a target. So if you announce a reduction target, we see actually a 10% attenuation relative to the average effect of monetary policy. Okay, so I was thinking about, where does that leave us? Are these large effects? And to me, it's actually not, it's not so clear, right? So just putting out a few observations there. If you look just, in relative terms, look at the effect of having high emissions and announcing a target, relative to having the effect of probability of default is actually quite large, right? So it's quite a sizable effect. On the other hand, in absolute terms, it's really just a few basis points. So, yeah, I'm just trying to think, how we square these effects. And one thing I noticed, if you look at the summary statistics, on average, the spreads in the data here are actually not that large overall, right? So the mean credit spread is 1.5%. At the 95th percentile, it's still at 2.7%. So that could explain why overall these absolute effects are relatively small. But yeah, just thinking about this. The other thing that stands out is announcing an emissions reduction target seems to have a really large effect on credit spreads and also how you respond to monetary policy. Now I will get back to that. Okay, then my second comment was I would just like to see a bit more descriptives on what the sample of firms looks like here. So I already said the sample is restricted to public firms. Kind of are these big firms are recovering the big polluters in Europe? What kind of industries are these? And the reason I'm interested in that is because I think it's important for thinking about real effects. Yeah? Large emitters really matter the most for aggregate emissions reductions, which is what we ultimately care about. And they may also be less bank dependent. Okay, just to go over that a bit, so here I just computed the average emissions so this is now true cost, not refinitiv, but I think it should look similar in your data. If you just compute the average emissions by quintile in the true cost data, you see this incredible skewness. Yeah, so almost all the emissions come from the top quintile. So you could, looking at this, you can almost say, it doesn't really matter what the first 4 quintiles do. It's really about what the top emitters do, what matters for aggregate emissions. And those firms, on average, actually do reduce emissions. If you compute their forward emissions reduction from today, you will see on average they are reducing emissions. Okay, so tying that back a bit to the paper, thinking about the real effect. So first of all, I want to say the paper is actually quite careful in stating just because monetary policy has a bigger effect on brown firms does not mean that does not imply that restrictive monetary policy is kind of green, right? And it might actually be the opposite even, right? Because we have this high skewness in emissions, we really need the brown firms to make investments and to bring down emissions. And yeah, there's some recent paper, for example, by Hartzbach and Schuh, who argue, brown firms' emissions respond most to cost of capital changes. So it might actually not be such a good idea to increase their cost of capital. So, it's kind of a collection of loose thoughts, but maybe bringing this back to the paper, just thinking a bit more about, what does the sample look like? And perhaps you could even directly explore whether there's kind of a non-linearity, what is the effect on kind of the top emitters that ultimately we really care about if we think about aggregate emissions. Okay, then my third and final comment is getting back about the effect of emissions reduction target. So we see this big effect. If you announce a target, then you benefit from first lower credit spreads, and second, an attenuated credit spread response to monetary policy. And this is quoting from the paper now. Interpreting this result, this suggests that bank interest rates are set so as to encourage firms' investment emissions abatement of emissions where such investments are particularly needed. So just thinking about these results, I was thinking, what exactly do these firm commitments actually capture? So first, one way we can think about this is it could be a forward or a backward-looking measure. Yeah? Forward-looking, you're really committing to what you do in the future. Or it could be just backward-looking, just pure signaling, right? I'm already green, there's like a selection effect, I'm already green, so I'm going to make a commitment, it's easy for me. So it could just be backward-looking measure as well, capturing whether you're already green. We could have a strong commitment, we're really going to stick to this, or it could be just kind of on the other extreme, greenwashing. You make this announcement, but you don't follow up of it. And one thing I had here, probably banks are not naive, so they're probably one of the more sophisticated investors of a firm. So my thought, maybe you can, as a starting point, say banks would be able to look through greenwashing. They would not be fooled by that. The way I read the paper is the interpretation of the target result is that banks understand that committed firms reduce emissions, so kind of taking this forward-looking, no greenwashing view. Just putting two alternatives out there. I don't want to take a strong stance. What is exactly going on? I'm just saying it would be good to think about it a bit more. It could be, it could still be greenwashing, but banks know it's greenwashing, but they like it because, now they can also greenwash. They can say, look, we're lending to these green firms, so it's just passing on the greenwashing. Or it could be this backward-looking measure, that it's just a commitment that signals lower exposure to climate risk. So then it would be just, another measure of how much you're currently exposed to carbon risk. So it's another measure of greenness, basically. Okay, so that brings me, perfectly to my conclusion. So I think it's a super cool paper. It really touches on a lot of different topics: monetary policy, climate risk, bank lending. It uses amazing credit registry data. So I absolutely recommend everyone to read it. I think the key takeaway is, banks price climate risk, and the effect of monetary policy seems to be asymmetric in that there's a stronger effect on the credit spreads of brown firms. And I'll leave you with my comments here, and thank you very much.